The stock market, of course, has been a little crazy lately. Let's talk about the mechanics of what actually happens when a stock just goes through the roof and surges. Now, of course, with AMC and GameStop, it's fair to say there has been a slight degree of manipulation there based on retail investors piling together to, again, manipulate the stock. But how does this really work? Okay, one of the things about the stock market, historically over the past 100 years or so, it's gone up by 10 to 15% every single year. Every single year. So this is just what it is. If you look at it from the standpoint of a long-term investment horizon, then obviously it's going to go up. But in the interim, in the short term, there are fluctuations, and you will have highs, you will have lows in between, but over time it will just go up steadily. But in those highs and lows, that creates sup markets, if you will. You may have heard of day traders. They go in and bet on that volatility that happens on a day-to-day basis. Go look for yourself if you have an investment app. Go look at the 1 day activity and see what the chart looks like. It's like crazy. Then you look at 1 month, it's also crazy, but a little less so. You look a year, you can start to see what the long-term trend may look like. Now, if you look 5 years, then you can see how it looks, and you can see those little dips, and that's, again, where that short-term volatility operates. Now, why do we have that? So one of the things that's beautiful about the stock market is any type of company can create liquidity, meaning they can sell a piece of their company and they can get cash. For investor to hold a piece of that company, they can sell it right away, so it's not locked in. It's not an illiquid investment instrument, such as, if you invest in an energy field or oil and gas, something like that, where you're in private equity, your money's locked up for a period of time. Here you get that liquidity. That liquidity comes with a trade-off, and this is one of them. Now, one of the things, if you're one of those people that bet on those swings, you only make money if you cash out on top. And whenever there's a possibility or an opportunity for high returns, there's night and there's day, there's hot and there's cold. There's just a greater chance that you can lose the equivalent amount the other way. So just always be mindful of that, because it's so easy to see those things and jump into it. But once the hype happens, it's, most times it may be too late. Now, you can do little things like you can say, oh, I only want to sell or buy at this price. I get all that. There are ways to do that. But what I would say, and again, I'm not your financial advisor, and I'm not at liberty to give you advice or tell you what to do. However, the data shows that if you invest with a longer term horizon, put your money in there and don't look at it for 2, 3, 5, 10 years. The economy is just going to do what it does. Dips aside, even if there's a macro event that just makes it plummet. Just look at Netflix, Amazon in March. All the big ones, they dipped, they tanked, but they came back up because it was just that emotional reaction from investors comes in there, and it just does what it does, and it has an impact on the market. But over time, it will continue to go in that direction. So that's my philosophy personally. But again, with GameStop, AMC, and that whole Robin Hood thing, that is tricky, and it's a developing story, to say the least. So what's going to happen next? Hard to say, but I will say this. This is helping bring investing into the everyday discourse, which normalizes discussing assets and understanding things that were only reserved for conversations for certain professionals. So that's a net positive. If we all get collectively smarter and wiser about how we deal with money, understand money, that's a win for everybody, especially right now.